Okay, let's unpack this. When you think about trading, what immediately comes to mind? For most people, it's pretty binary, right?
Yeah, you're either going long, betting the price goes up.
Or you're going short, betting it goes down. Simple.
Maybe, sometimes people add a third one. Just staying out completely.
Right, staying flat. But what if that's really just scratching the surface?
Well, it's interesting how we simplify things, isn't it? Down to just those couple of choices. Feels intuitive.
But maybe too simple. The source material we've been exploring, it suggests that perspective is, well, missing quite a bit.
A significant part of the picture, yeah. It seems counterintuitive at first.
It really does. We've been diving into this material that suggests a far more complex landscape. It proposes that instead of just 2 or 3 options, there are actually 12 distinct choices a trader is constantly facing.
12.
And
Yes.
these 12 choices directly impact their equity, their bottom line.
12. It sounds like a huge jump, maybe overly complicated, but the key, as the source points out, isn't really about added complexity for its own sake. It's more about gaining a clearer view.
Like getting a sharper lens on what's actually happening.
Exactly, sharper focus.
And that's really our mission for this deep dive, isn't it? To understand where these 12 choices actually come from, put them in context,
Mm-hmm.
and see how just being aware of this full spectrum might give a trader a critical edge.
And a big part of that edge, the material suggests, comes from understanding where other traders are likely, well, getting it wrong.
Right. It's not about predicting the future price down to the penny.
No, not at all. It's about seeing the entire field of potential decisions that are always kind of on the table.
Okay, so let's start there. That's standard view.
Mm.
Long, short, maybe stay out.
Yeah.
It feels like the default because, well, you're either buying or selling the thing or you're not.
Right. Seems like the only actions you can take on the instrument itself.
But the source challenges that. It says there are 12 total choices that will directly affect your equity. Gain or loss over time ties back to decisions made from this set of 12.
Okay, so if that's the case, why identify all 12? What's the strategic advantage? I mean, aren't we just trying to figure out whether to buy or sell?
That's the interesting part. The purpose, surprisingly, seems to be to help narrow your focus, not broaden it indefinitely.
How so? By seeing more choices.
By seeing the whole universe of potential actions, the idea is you're better equipped to stay aligned with the underlying order flow.
Ah, the order flow. So where the dominant buying and selling pressure actually is.
Exactly. And crucially, this 12-choice framework helps you use multiple time frames
Okay, that's key.
to understand the broader market context. And maybe most powerfully, like you said, uncover where the losing traders are likely positioning themselves incorrectly.
Ah, okay. So it's like having a really detailed map, not just to find your best path,
Yeah,
but also to see where the common pitfalls are, where others might stumble.
precisely. Identifying those spots helps you anticipate shifts in order flow.
And maybe find better entry and exit points before those shifts really get going.
Okay, so how do we get from just long short to these 12 choices? The source material seems to build this step by step. It starts with 6 core strategic directions.
Yeah. Before you even think about the mechanics, clicking buy or sell, getting in or out, you're inherently making a higher level decision, a strategic one.
And that's based on what the market's doing right now, its state.
Exactly. Its current state and the prevailing order flow.
And the market, broadly speaking, can usually be seen as being in one of 3 states, right? Downtrend, uptrend,
Or a
or...
range, yeah, stuck between levels.
Okay, so let's take the first state, a clear downtrend. Sell-side order flow is dominant. What are the choices then?
Well, the first strategic choice is pretty intuitive. Go with that trend. Go with the flow.
So look for signs the downtrend will continue and find spots to sell, aligning with that existing pressure from sellers.
Correct. That's strategic direction number 1. Sell the rallies, basically.
Okay, what's the alternative in a downtrend?
The alternative is to fade the trend, trade against it, meaning you're seeing signals that the order flow might be shifting, maybe from offer-dominated to bid-dominated, signs of buying interest starting to emerge.
So you might choose to trade against that immediate downtrend. You'd be looking to buy, anticipating a potential bottom, a reversal.
Exactly. That's strategic direction number 2, looking for that turning point.
Okay, now flip it. Markets in an uptrend, strong buy-side, bid-side order flow. What are the options?
Same logic, just reversed. Option 1, strategic direction 3, is go with the uptrend.
Buy the dips. Look for places to get long and join that prevailing bid-side pressure.
Yep, that's number 3.
And number 4 must be
Fading the uptrend, looking for signs the market's running out of gas. Maybe clues the bid flow is weakening and sellers, the offer flow, could start stepping in.
So you might decide to fade it, look for a place to sell, anticipating a potential top and a pullback or reversal.
That's strategic direction 4, selling into strength, expecting it to fail.
Right. Okay, that covers trends. What about the third state, the range, when it's just bouncing between levels?
Yeah, the range market.
Mhm.
Often a period of, indecision or maybe accumulation or distribution before the next big move.
So what are the strategies here?
Well, choice 5 is to trade within the range. Go with the range boundaries.
Meaning like sell near the top and buy near the bottom.
Exactly. The source suggests typically selling near the top 5% to 10% of the range and buying near the bottom 5% to 10%.
Okay.
And it even notes if the range is clear enough, you could potentially be actively long from the bottom area up towards the top and then short from the top area down towards the bottom.
Interesting. So playing both sides of the oscillation. That's number 5. What's number 6?
Number 6, when you're in a range, is to trade against the range.
Betting on a breakout.
Precisely. You're anticipating it won't hold. So you might buy, expecting an upside breakout through the top resistance.
Or sell, expecting a downside breakout through the bottom support.
Exactly. That's strategic direction number 6. Playing for the range to fail.
Okay, got it. So those are the 6 core strategic paths determined by the market state. 2 choices in a downtrend, 2 in an uptrend, and 2 in a range.
That's the foundation.
So we've got these 6 foundational strategies, but we're aiming for 12 choices. How do we bridge that gap from 6 to 12?
Well, think about it. Once you've committed, mentally at least, to one of those 6 strategic directions, let's say you've decided, okay, my strategy is to go with the current uptrend.
Yeah.
You still have to actually do something, right? You have to execute. And that involves 2 further really fundamental decisions tied specifically to that chosen strategy.
And these are about the execution itself, like where you actually, pull the trigger.
Exactly. Decision A, where or maybe when do you actually get in the market? Initiate the trade based on that strategy.
Yeah, the entry point. Makes sense.
And then, assuming you're in the trade, you're not just going to hold it forever. You have to decide
where or when to get out.
Yeah.
Close the position, take profit, or cut a loss.
Precisely. That's decision B, the exit, or as the source calls it, the liquidation point.
So, wait. For each one of those 6 strategic directions we just outlined, you also have these twin decisions. How and when to get in, and how and when to get out.
That's exactly it. They are distinct decisions tied to executing the chosen strategy.
So do the math. 6 strategic directions times 2 entry-exit decisions for each.
Gives you the total of 12 choices,
Yeah.
12 distinct things that are inherently present and impact your P&L whenever you're thinking about engaging with the market.
Huh. When you put it like that, seeing it as 12 possibilities instead of just buy, sell, wait,
Yeah,
it really does open up the mental landscape, doesn't it?
it does.
It's not just about the direction of price, but how you choose to interact with that direction within a specific market context and how you manage the position.
And the main point from the source isn't just listing the 12 choices. It's about recognizing them so you can consciously narrow them down, filter them.
Right, not get paralyzed by them.
Exactly. The power comes from identifying the best 1 or 2 of those 12 opportunities at any given time.
Right.
And the source as the primary tool for doing that filtering.
Is using multiple time frames. Yeah, you mentioned that.
That's the key.
Okay, multiple time frames. This feels like where the rubber meets the road, where the real edge starts to sharpen up. How does seeing these 12 choices in the